What we are going to look at is a comprehensive question that was tested in August 2025, question 2C of CPA, Financial Management paper under CASNEP. The question is displayed on the screen and it reads, assume that you have just won a competition prize with the following options. Option A, we have lump sum payment of 25.8 million in 5 years' time. We have option B, option C, option D, and the question asks, required, assuming a required rate of return of 8%, advise on the payment option that you will select. And the total marks allocated to the question are 7 marks. After having analyzed the question, you'll realize that the question is testing us on discounting techniques and present value analysis or concept. Remember, we said that present value is the value today of future cash flows after discounting them at a given required rate of return. So from this question, we can see that the examiner is testing us on whether we can identify the type of cash flow, apply the specific present value technique, and compare the alternative payment options, and finally recommend the option with the highest present value. So it's important to know that each payment option in this question represents a different cash flow. For example, you realize that option A says lump sum payment of 25.8 million in 5 years. You have to find the present value of a single cash flow. Option B says a sum of shillings 16 million paid as follows: 5 million payable today, 5.5 million to be paid after 1 year, 5.5 million to be paid after 2 years. So you realize that this is present value of mixed cash flow. And option C, annual payment of shilling 1.4 million for 30 years, the first payment being made at the end of the year. If the payments are made at the end of the year, then that means that is just an ordinary annuity. So you have to find the present value of. And now option D, says a perpetual payment of shillings 1.38 million. So if these are perpetual payments, then this means we have to find present value of. So this is just the question analysis. So we are going to convert the cash flows given under each option, this question, to their present values using our required rate of return, which is 8%. And the option that will give the highest present value among these 4 options is what we are going to recommend to be selected. So let's start to work out this question. We are going to use the other side of the board. Option A, we said that it is a present value of our present value will equals to future value bracket 1 plus R raised to negative n. This is the present value interest factor. R is equals to 8%, and put these figures in this equation. 25,800,000 times. So our present value equals to 25,800,000 times present value interest factor. So you can just look that from our tables. Go to 8%, 550 here, you get that it is 0. When we multiply, you're going to get that our present value equals to 19,559. Option B. We are being tested on calculating the present value of. Still here, you have to apply present value interest factor and discount each cash flow to today's value. Present value at year 0, which is today, is given by going to give us 1, and then present value at year 1 is equals to 1 plus 0.08 raised to 1, which is going to give us the present value at year 2. Now, having found the present value interest factors for today, year 1 and year 2, we are going to form a computational table in this form: cash flow. Going to write this way. This is just like the present value interest factor. Year 0, we had 5 million. At year 1, we had 5.5. At year 2, we had 5.5. And at year 3, it was 0.9259. So to get the present value, I'm going to multiply this amount by the present value interest factor. 1,715,000. Total present value under option B, we are going to add, we sum these cash flows, 14,807,600. So that's the present value under option B. Option C is testing present value of ordinary annuity. Use this formula: present value is equals to times present value interest factor of an annuity at a given rate and time. and our PMT is 1,400,000. So we multiply by present value interest factor at a rate of 8%. N is 30, so it will equal to 1.4 million times. We can confirm this from our present value interest factor table. So you go to 8% and you match it to where N is 30. So you get that it is 11.25. You're going to get 15 million. So option B says that perpetual payment of shillings 1.38 million. So that means that this person is going to receive 1.38 million annually to infinity. So to get that, we are going to use present value of a perpetuity, and that we are going to complete using the other side of the whiteboard. The value of a perpetuity is given by the payments divided by R. R is our rate. In this case, our payment is equal to. We just substitute those figures in this formula. This is the present value under option B of present values. So under option A, we got a present value of shillings 17. Under option B, we got, having computed the present value under each option, you realize that among these four options, the option with the highest present value is option A, which has 17,559,408. So our recommendation, we will say that select option A because it has, that is shillings, and that is 7 marks. That's how to compute that question. Let's move to the next aspect.